Hello, everyone. Hopefully, you're having a good day. My name's Andy. My channel is Finding Value. Today, we're going to go through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll share my opinion as we go through it together. If you want to follow me, it's at Finance, and if you want to join our community, finding-value.com. I dive deeper into all these different topics. This next topic we're talking about this weekend is about portfolio position sizing, risk rewards, setups. We're going to throw physical metals in it and kind of how I allocate my portfolio across all those things and the reasoning of why behind it. We do have a coupon code Black Friday, which is one word altogether. Gets you a discount, 50% off on the first month and a larger discount on the yearly membership, Black Friday. So let's dive in here. We've got Joe. He says, Finding Finance, you're great, but I notice you stick stubbornly to one thesis in spite of growing evidence to the contrary. You miss loads of things in macroeconomics as they happen over months to a couple of years. Well, what I have prescribed to is that commodities are cheap. I prescribe that the real estate cycle is a large driver of a lot of things. I think that we have gone from a declining interest rate environment to an increasing interest rate environment. And the way that I invest doesn't mean that I capture every single small trend. What I do is I look for the big trends and I try to capture and size the big trends that are occurring in front of us. I think that we are at the end of a trend, an end of an upward move in the stock market, the S&P 500 and the NASDAQ. I think we are in a bubble there based off of valuations. I think eventually they will roll over and go either down or sideways for a good decade plus. I think commodities will outperform. I think precious metals will outperform. And that's where I want the full exposure to. Trying to trade in the short term also has a lot of negative tax consequences. Depending on how much money you make in a year, it can be drastically different for some people and the way that they view the market depending on how much money they make. I'm not going to tell you what tax bracket I'm in, but in order for me to make it worthwhile, you're going to have to time things in the short term where I am going to take large tax consequences. And I think that's going to be the case for people who've been in the markets for a while. Positions are bigger over time than what they were when I first started. If you're making six-figure gains in positions and you have to pay taxes on top of what you make and your dividend income and all that other stuff, there's going to be big tax consequences. And yes, I try to put all my money as much as I can in tax deferred accounts, but you can put only so much. So it's not a function of trying to get the most return in the short time frame. And I do think what I'm doing is going to give me the largest returns with the lowest amount of risk. The thesis is the thesis. The thesis doesn't change. What you're arguing, I think, is where we are at in the real estate cycle. I think that's probably what you're alluding to. We are still in a boom phase, according to those that are experts in the real estate cycle. A lot of people have opinions, but they're not experts. And I'm not just saying that because they're experts. The data, when you go over in housing starts, over about 1.1, 1.2 million housing starts, you are in an expansion phase of real estate. The argument is, are we going to fall back out of it and cycle back down before we go back up again? And no one can tell you, and no one knows that information with 100% certainty. It's all opinions after that. We entered a boom phase most likely in 2019, 2020. We went above that 1.1, 1.2 million. The thesis is still in play that we're in an expansion phase of real estate, but things have definitely slowed. We haven't come back out of that. We also don't see that the data in terms of construction loans, construction money, I should say, so that's total money spent in residential construction and the employment in construction. It hasn't rolled over yet. It doesn't mean it can't. So it would be too early to say that the evidence is contrary to what my opinion is because the data is still telling us that the housing starts is in a boom phase and that construction employment hasn't rolled over yet, which generally is a precursor to a recession. There is evidence in other areas that are muddied. An inverted yield curve that could be uninverting, but that uninversion of the yield curve is muddied by the release of short-term bonds by the Treasury. It gets real muddy here. So when I make a decision that something has changed in a big, long picture view, I then have to sell out of my positions. I lose my position. If you've read books extensively, if you're sizing up a big move, you don't want to lose your position. That's one of the greatest mistakes. A lot of the big long-term charts are still looking good for my opinion and thesis. The home builders continue to go up and most of them are making new all-time highs. Some of them have broken long-term horizontal trend lines to the upside and look absolutely fantastic. Contrary to what most people think on Twitter. I feel like I've got a better handle on data than the majority of people on Twitter, and that's only based off of me looking at the data myself. And that data is a accumulation of all of the charts that I look at and forming my own opinions about all of what I see. Changing your opinion in the short term and trying to play the short term market movements usually ends up disastrous. So what I do is I size up the big moves, I size up what's cheap, I use the valuation at my back to protect me against downside moves. Most people in the markets, all they look at is the price and the returns of things, not the value of anything. So what they focus on is they say, oh, well, crypto's going up. I don't know what the correct value of crypto should be. I know that technology and the NASDAQ are overvalued or overpriced. And they're vastly overpriced in comparison to commodities and emerging markets and other areas of the world. I'm going to play what I am really good at. I'm going to play my game and I'm going to make the money where I think the risk reward is the best in the market. It gives me the largest cushion for margin of error and all of that stuff. I am not going to buy crypto no matter what people tell me. I won't go into it unless we somehow figure out a great use case for it. I just don't believe in digital stuff, guys. I'm not a technology nerd. I'm a car loving, hard asset, looking at things from the world from a mechanical view. I don't look at things from an electrical digital software view. I just don't. My cars, I don't want digital crap on it, and I don't want software on my cars. I want things that are hardwired with dials and gadgets that are more robust and more robust and resilient to breaking. Like I'm just a mechanical guy. Like that's my mindset. So when I look at things, I look at minerals, I look at the inputs of production, and I just view the world through that paradigm. So the thesis is correct. What you're arguing is where we're at in it. Um, that is kind of what you're arguing, and I don't think anything's changed from my perspective. And when you get loads of gains, if you're lucky enough to get loads of gains, you have to figure out tax consequences for it. It's not about should I sell and try to make the most amount of money. I used to be like that when I didn't make as much money. But if you make more and more money and your position size get bigger and bigger, as you become more successful, you're going to lose a lot more to taxes. And you have to be very careful on what accounts you're doing this in. I mean, obviously, you try to put as much as you can in retirement accounts, but sometimes it's not possible, and you might have different strategies for increasing your income that might be out of retirement accounts if you're younger than 55 years old or 59 or 55, whenever the amount is where you can start taking stuff out. So I don't think that anything has changed. My approach is going to be the same, as boring as it is, and I don't think the data necessarily is going to. It won't influence me to change my mind because we're still short on homes. And even in the short term, even if we were to dip below in the short term and get a recession, we still have to build those homes at some point. So what's going to happen is your interest rates will come back down, and more than likely housing starts will go back up. And that's my view. Now, if I'm wrong, then I'll have to be wrong about my opinions. And I'll have to somehow change my opinions, showing me that we have um, that interest rates going down and inventories going up simultaneously would mean that I am in the wrong camp and that I have to change my mind. But right now, we don't have that yet. We have we have homes going up. Some of the inventories are going up, but now we have to watch if mortgage rates come back down. How does the market handle all that? That's what we need to see next. The Great Marti says 1987 versus 2024 Dow Jones. It says, let's analyze the lead up to the 1987 crash versus now. 12-month performance, notice the upthrust steepness. So what he's doing is he's comparing the Dow Jones of today, 2024 coming up, with the move in 1987 and then the sell-off before it. You can see a sharp sell-off, and then you can see a bull trap, and then the big move lower in 1987. Now, here's another thing that I want to make, um, something that is obvious to me, but I think is not obvious to a lot of people. Market pullbacks are temporary. So if you look at the markets from a negative sentiment that we're always going to have a crash, you won't do well in the markets. You have to have an optimistic mindset. And if you look at everything like, oh, it's just a temporary pullback, and then you start going up again, that's the way that I view things. I view things from an optimistic standpoint. Now, this very well could roll over. And I'm not in the Dow Jones. I'm in more commodity and energy related stuff and precious metals because that's where I think the value is, and that's what historically has outperformed. And I'll show you guys what I mean by that. But this very well could roll over. And I think the Dow Jones and S&P and NASDAQ will roll over at some point soon. Within the next year would be my guess. Now, this is the person I'm going to respond to. It says, Finding Finance. Kathy Woods is a well-respected CEO of ARK Financial. And if her vision of Bitcoin is correct, then this is less a bubble and more buying Microsoft in 1998. So when I purchased oil in 2020 and I went in pretty big, people were shooting me messages just like Friar Tuck here about Kathy Wood saying that oil is never going to get above $40 a barrel again, and that oil is going to be like whale oil and go out of style or whatever she was saying. And I just sat there and laughed. I was like, how can this person run this amount of money and be so clueless on how the world works? Absolutely clueless. Now, would I listen to Kathy Wood? I would listen to maybe what she has to say, but I don't think she has a good understanding of anything. In my opinion, maybe in technology, maybe she knows a lot of stuff in technology that I don't know. But overall in the markets, I think she has no idea where we're at cycle wise at all. So 1998, that was kind of right before the big bubble in 2000, 2001. I think we're more in the line of 2000, 2001. And I don't. When I look at Bitcoin, it's not about a vision. These okay. So number one, I'm not a tech guy. I'll just say that up front. I'm not a tech guy. I don't like. I don't buy the latest phone. I don't buy the latest computer. I don't buy the latest crap, guys. That's just not me. And I'm not going to put a ton of money in something that I don't believe in. I believe that the world is going to get into an energy crunch within the next 5 years. And I think Bitcoin will be a victim of an energy crunch, not a benefactor of it. I think technology stocks are going to eat it during this time frame. I think precious metals are going to do insanely well because of what I think is coming over the next few years. Now, that doesn't mean in the next 6 months that Bitcoin's not going to go through the roof. It also doesn't mean that Bitcoin going up is is any sort of evidence that Bitcoin adoption is going up. I can't find any reason of any single person who is either in Bitcoin or out of Bitcoin that bought Bitcoin for the reasons that Bitcoin is so good. They are all buying it because they either think that they are going to get rich off of it, or they think for some reason that it's going to store value over a long period of time. I don't think any of that makes any sense to me. I don't understand why Bitcoin would be a store of value at all because technology has changed since I've lived in my life. Here's the obvious facts that I've seen throughout my life. We used to have tape players, and guess what happened to tape players? Technology came along and created CDs and the DVDs. Then over time, that went away, and it was MP3 and MP3 players. Eventually, cell phones changed, and that went away. And you could play music on your cell phone instead of carrying an MP3 player or a CD player or a Sony Walkman. As technology progresses, all of these things change and morph over time. Bitcoin to me is more or less just an extension of the technology bubble that we are in today. It is a creation at the beginning of a technology favorable era of 2010, 2011, and we've been in a favorable area or era that entire time till probably 2020, even 2024. We're still in that era and it hasn't ended yet. And some people are caught up and they're in the bubble. So I think it's a bubble and I could be wrong. But it doesn't mean that I should be in it because I don't believe in it. I have no conviction in Bitcoin at all. Now, just because I don't have any conviction doesn't mean it can't work. I just don't believe in it. So, me not believing in it doesn't mean that I should be there. Just because it's going up, oh man, you missed out. I didn't miss out on anything, guys. And that's the wrong mindset. If you don't understand it, if no one here can tell me what the value of Bitcoin should be, what should be the true value of Bitcoin? And I think that's where a lot of people struggle. That's where I struggle. I struggle because I don't know how to value it. And you know what? When I don't know how to value something, I don't get in it. I don't play that game. It's like taking Michael Jordan. He's great at basketball, and that's the game he plays. It's like taking Michael Jordan and saying, "Hey, look, Michael, we know you're a great athlete. Let's go put you in baseball." And he's like, "Dude, I'm good at basketball. I don't want to play baseball." Bitcoin is Michael Jordan's baseball. Just like, I mean, that's what Bitcoin is for me. It's Michael Jordan's baseball. He can't play baseball. I don't play Bitcoin. I don't play technology stocks in some of these areas. Now, have I done technology stocks? I did. And the ones I played were like the ones that are obvious. The Google, you could tell that Apple was going to crush it when they first came out with the iPhone in like the early 2000s. It was an easy call. That's what I play. I don't play this stuff where I don't even know how to value it. No one else does either. So I view that as a really risky proposition. And other people may look at it completely different and say, I'm a kook. It's fine. I'm going to continue to play my game that I know. All Things Venture says, here's another thing. I put some information here. What I do is I look at data and I use data to support my opinions. And it's not about being right or supporting an opinion. It is about nailing where the least risk is in the market where I can load up on cheap assets. So when someone says Bitcoin's going to do so great, this is the NASDAQ to commodities ratio. Whenever you're up here, you're expensive. Commodities are cheap, NASDAQ is expensive. When you're down at these bottoms, this is where you want to buy the NASDAQ and you want to sell your commodities. Sometimes these turns take some time. It doesn't mean it will be immediate. I think, in my opinion, is this squiggle here is probably this squiggle in here. We had a move lower, and then we've got one last final peak. That's where I think we are going to peak out as sometime anytime soon. When you look at a bell curve of this ratio, and you were to put a bell curve on this end here, the majority of time, the average would be about 15 or something. The low point is under 5. Your high point is anything over 30. And it just becomes obvious and easy to me. You don't go in the NASDAQ when it's expensive. You go into commodities when they're up here. So I buy commodities, and I buy commodities, and then I sit and I wait for this ratio to turn. The ratio will turn when the market conditions come and are ripe for that to occur in. It's that easy. So if the NASDAQ, if everyone's playing this move here, that's great, but I don't think they know the value of it. I don't think they understand the risk that they might be taking being in those assets and the potential for them to roll over. Another thing I look at is the commodity to stock ratio, commodities to Dow Jones. When this is low, I go into commodities. When it's high, I look at other things, maybe like equities in these time frames. Now, just because it doesn't turn fast doesn't mean I'm right or I'm wrong. And I may have to sit in these for a little while for it to play out in, which is fine. All I need is one big move like this, and that's all it takes. I don't need any more moves. Because if you capture one of these moves, either in the up cycle or the down cycle, the moves are so big, I'll make so much money, it just doesn't matter after some point. I'm not here to become a billionaire. Maybe I will become a billionaire. I don't know. But once you hit a certain, I'll say, dollar value, once you hit 4 million or 10 million or whatever your value is, making more money is not going to change your life. Just, it's not going to matter after some point. You don't have to take all the risk in the world. You don't have to buy assets that you don't necessarily understand. You don't need the maximum return. I don't need to turn into a gambler. But where I think we're located, I think we are located in 1970-ish era or late 60s. We're in a very cheap area of commodities versus asset classes. So this is what I'm using as a guide or thesis or whatever you want to call it to make my decisions. Now it's a function of me sitting in them and just waiting. And we also have positive technicals across all of the commodity space. We also have gold ready to break out on the S&P 500 and the NASDAQ. Once that rollover occurs, either upward or downward, however you put the ratio, the whole ball is shifted. The paradigm is shifted. And I just bought a whole bunch of cheap commodities that I've been sitting in that I'm going to make a buttload of money on. And eventually I'll have long-term capital gains that I'll have to pay at some point, not short-term gains, which is lower taxes. And hopefully I'll have enough in my retirement accounts too, where things just don't matter. And here is also the gold to oil ratio. And I know gold's real cheap, but look at where we're at. We're in these really high areas. Right now, it's just under 40 is where we're at currently in 2024. It's like 38, 39, wherever it is. And that is off the page cheap. That is the game I play. I buy cheap assets and I just wait for them to get expensive. It is literally that easy. And here's Microsoft. If Microsoft was in 1998, that puts you right like in this area over here. So you had a big run, 98, and then you have that big sideways action of about a decade worth. 98 all the way to 2018 would get you up here. So you just started breaking out in 2016, 17 of new all-time highs for Microsoft after 1998 and 99 here a peak. So this is what I think is coming, is this sideways action here, or a bigger pullback depending on what you're in. So I'm going in with the undervalued stuff. It's really that simple, guys. Reflecting on the disappointing tanker rates and how we got here, not only was my very contrarian take on increased Iran production bearish as predicted, it was made worse by the Biden administration encouraging illicit trade to China instead of making a deal which would have seen the Iran's oil shipped on modern tankers instead of old dark fleet rust buckets that otherwise would be scrapped. The good news is an adult is coming back to the White House and will deal with the Iran issues properly. He will either enforce the sanctions or make a deal. Both bullish tankers because both outcomes see less oil shipped on dark fleet rust buckets, in his opinion. And that's all things ventured. And he's been on the channel before. Steve Burns, Charlie Munger said, if all you ever did was buy high quality stocks on the 200-week moving average, you would beat the S&P 500 by a large margin over time. The problem is few human beings have that kind of discipline. And that's where I'm at. I'm in massive discipline in taking a stance and going and working to that stance. I'm not chasing performance. I'm not chasing where things are going up. I'm chasing value in the market and being patient for that value to play out. That is what I've learned from Buffett. That's what I've learned from Lynch, Howard Marks, all of the greats. And that's really the only way that you can make money consistently with reduced risk. Otherwise, if you're chasing price performance, which almost everyone does, again, that's where the quote comes from. Everyone knows the price of something, but nobody knows the value of it. You get into problems chasing price because the value is what really will ultimately have an impact and determining factor of where price eventually ends up. If the intrinsic value of Bitcoin is zero, that's where it will eventually end up. Now, some people think completely different, and maybe they are right. I'm okay with taking and missing that, quote, trade. Gold to platinum ratio over the long term, I'm just stating it's at near 125-year highs where gold has outperformed platinum. Now, here's the thing, guys. I don't have to be right on everything. All I have to do is find some of these anomalies in history. This is going back to the 1800s. If I buy a bunch of platinum here, I buy a bunch of oil that was incredibly cheap on the ratio, which is up at 38, which is also an anomaly in history. Going back to 1860, there was two times you could buy oil as cheap as it is today. Two times. And I've got and platinum is the other cheap one here. All I need is a few of them to work out, or just one of them to work out even. And if one of them works out, I made it. Out of 6 or 7 different ideas. I put enough money in 6 or 7 different ideas. I need 1 or 2 to work, and I am good for the rest of my life. I don't need everything to work out. I've got enough in each of these that it will make a life-changing move for me, which is great. I've been saving since my 20s, and I've been investing since that time frame. Break wave. If falling rig count in the U.S. suggests oil output will struggle to rise in the near term. Agreed. Falling rig counts are also going to be good for energy service companies because we're going to have to increase the rig count at some point if we want to increase production. Now, some of these areas are going to be constrained to the geology. And I hate to say it, but increasing the rig count may or may not increase production. Now, here's the thing. Oil is like the most important thing for human beings. It is the economy. If we have problems in oil, guys, oil is going to be the best trade of anything because oil is so valuable to humans. It provides so much work and so much contribution to GDP, which is 0.996 correlated, the R squared value to GDP. It's 99.6% correlated. Richard Meyer says European natural gas demand may be down in aggregate, but EU natural gas storage withdrawals in November are at their highest level on record since at least 2011. Gas remains critical, especially during Europe's recent cold and windless weather. This could get interesting here. It very well could. You can see where we're at. We're right there. Really, really low compared to history. And if they continue to have windless and cold weather, they could really eat through natural gas storage. Gold production and all-in sustaining costs for quarter three 2024. This is something interesting. Sustaining costs. Look at the increases of a lot of these. I'd say just by looking at it, your average increase 10 to 15% would be my. Newmont's at 1,600. There's a $1,700, $1,600. Looks like the lowest is 877. The highest here looks like to be $2,000 with a 22% increase year over year. So there's your all-in sustaining costs here. You know, a great play is just buying the physical metals. Like just don't take any risk and just buy the physical metals. Let these cost curves continue to increase, and that will essentially be your return at some point. Your cost curves continuing to go up. I think they're going to skyrocket way out in the future, like 5, 6 years out in the future. I think all-in sustaining costs could skyrocket due to oil prices. Grady says gold and Bitcoin is fighting it out right here about which one's going to take the lead. If the ratio breaks below the pink line, which is this bottom line at the bottom here, Bitcoin takes the lead. If the ratio breaks above the blue line, gold takes the lead. Well, what if we get like a false breakdown and then it slingshots to the upside? Like you got to watch out for that too. Grady says gold has a mega breakout versus the U.S. Consumer Price Index. The inflation-adjusted gold price having a 44-year breakout has absolutely massive implications going forward. And silver is in catch-up mode, which will lead us to its huge cup and handle breakout. I think these are both insanely good opportunities here. Gold is a good opportunity, silver is a good opportunity, and having some money in the miners are also a good opportunity at this time. So those are all ideas that I would use. Peter Lynch says a share of stock is not a lottery ticket; it's a part of ownership of a business. And I'll say the more that people realize that you're buying these things that are going to create wealth in the economy. There's some things that you have to look at too from the financial side, but you just buy them and you sit in them. Investing it's not gambling. It's not supposed to be eventful. It's kind of boring, guys. And you'll just bounce around for a while and then you'll get a nice big up leg. Commodities, the up legs are huge. And if you're in the right market condition at the right time, you make a whole bunch of money. Right now, we are still early and waiting for that big move. We had one big wave from 2020 into 2021, 22, and then we peaked out. We've consolidated, and now we're waiting for the next wave to come. That's really what we're doing. Jacob King says, if you're wondering why Bitcoin has been skyrocketing over the past few weeks, the answer is in plain sight. Tether, a shady, unregulated, I don't know if it's Chinese, printed several billion out of thin air and injected it into the network of corrupt exchanges. They are running the largest Ponzi scheme in history. When this inevitably collapses, We'll look back at the greatest financial disaster ever, one that fooled hundreds of millions of people. Well, it didn't fool me. I'm not in it. And there's a lot of weird things that are behind Bitcoin with some of these stable coins that I just don't believe in, Tether being one of them. And since I don't believe in it, I just don't partake in it. If people started jumping off a bridge that was incredibly high and there's a high likelihood of getting injured, I'm talking like it's up there, not like 30 feet. I'm talking, 100 feet, 150 feet. I'm not going to jump off of it. And even if people are doing it and they're not getting injured, I'll be like, nah, I'm good. I just don't want to do it. I don't think the excitement is worth the risk to my safety. So those are some things that I just don't do. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. I know we've got half day trading today on Friday, so we've got a Sunday question and answer session coming up at 5 p.m. We are going to go over portfolio position sizing and what I do, the way that I look at things, risk reward setups, the physical metals, all that stuff, and kind of how I position for it. Another idea that I've also come up with is we can look at potentially evaluating different strategies. Some of the strategies that I eventually came to, I kind of tested against other strategies. And we can go over what those strategies are and why I adopted some of those strategies. And it might not be this next one, because I think portfolio position size is it's a pretty hefty one to cover. But we could use that in a future question and answer session. So that's what I've got for today, guys. So we'll catch you next time. This is Finding Value.